Climate change remains a big issue today, on top of the ongoing impacts of COVID 19. And obviously, there's going to be an interplay between both of these crises moving forward. And so, what we're going to talk about today is about the energy sector because the use of fossil fuels drives most greenhouse gas emissions globally, about 75%. So, it's the main cause of climate change. And in the power sector, what that means is the use of coal and gas, such as LNG, are the main fossil fuels and the biggest drivers of the problem. And in the region that we'll be talking about in Southeast Asia, the fossil fuel projects, in the region, they cause, on top of climate impacts, significant land, air, and water pollution impacts as well. So we're talking about impacts on the livelihoods of local farmers and fishing communities, economic impacts, and so a lot of projects are controversial for that reason. So what's happening now is we're looking at countries that are moving away from coal or gas to renewable energy and more cleaner energy solutions. And these are going to be better on many fronts for health and for the global climate situation. So today, Sara will talk about what's happening specifically for Southeast Asia, because outside of India and China, the build out of coal plants in Southeast Asia, and some of which is funded through China's Belt and Road Initiative, for example. These are really the sources of growing global emissions and climate change. And so today, I want to thank Sara for providing us with this opportunity to learn about what's happening with the renewables development and deployment in Southeast Asia, and to hear about some of the nuances of the situation in different countries. So thanks, and I will turn it over to Sara to share her slides.
Thank you, Han, for the introduction. So I think my slides are now up, so I will start. So IEEFA is an energy finance think tank, and I'm based in the Philippines, and I've done my best to simplify the presentation, but if it ends up too complicated, I leave it to Han to go over it during the Q&A session. So to start, I'd like to give an overview of Southeast Asia. The combined GDP of Southeast Asian countries is almost $3 trillion US, and the combined population is about 650 million people. And this accounts for 8.5% of the global population, while occupying only 2.74 million square kilometers. And this is actually smaller than the land area of India. Southeast Asia's energy requirements have grown by 60% over the last 15 years and is forecasted to grow another 2/3 by 2040. And according to the IEA, the pace of growth will likely double that of other regions. Southeast Asian countries have young populations, with the median age being under 30 for most. We are seeing younger people not only move into leadership positions, but realizing incentive failures and market design failures, which can lead to energy instability, high prices, or high subsidies. And decisions made today will either cost them through higher taxes or high electricity prices, or if the trajectory shifts towards renewables, it can benefit them. And the bottom line is really cost competitiveness and job growth. Power tariffs are a pressure point, especially for countries that import a lot of their fuel needs. For example, the Philippines imports a lot of their coal and has tariff rates between 17 US cents to 20 US cents per kilowatt hour on the main grid. COVID-19 has exposed the fragility and inequities of the old economy. The spread of the virus has impacted industries, including the power sector. It has revealed weaknesses in aspects of the energy market and financing design. It's also accelerated some of the trends, such as the need for more secure and flexible, reliable power. But before I jump to this, it's important to understand that power sector planners assumed that a large system lock-in, such as coal, would lead to a least cost system. But unfortunately, this lock-in for countries has led to inflexibility, price instability, and high prices or high subsidies. And it also contributes to negative effects on the trade balance for importing countries. So during COVID-19, the drop in demand caused the realization that fossil fuels such as imported coal are inflexible in terms of prices and inflexible in terms of technology. So on the price side, this is because there's what's called a capacity fee, which is a minimum payment to ensure that the investor of the coal plant recovers their investment, which is typically a 14% to 15% internal rate of return. So this means that if demand drops, consumers or governments still need to pay a minimum payment, which leads to a higher per unit price of electricity. So this means that each unit you consume now costs more. Now, this either affects the end user who has to pay more, which is the case for the Philippines, or the taxpayer through more government subsidies, which is the case for Indonesia and Vietnam. So the force majeure clause in these agreements has triggered negotiations with coal power providers in order to protect government and consumers from inflexible standard clauses of the power purchase agreement, such as paying this minimum fee. However, even with force majeure clauses, when competition from cheaper alternatives enter the market, the question is whether end users or taxpayers will be okay to pay for fossil fuel lock-in and resulting price instability and high prices, and will they be willing to pay this high cost for fossil fuels amidst cheaper domestically resourced options such as renewable energy. And then on the technology side, the reason for the inflexibility there is coal plants are unable to operate below a minimum value, which means you can't really turn them on and off like you would a switch. So you have two options: either you blight the grid or you turn them off, but that has cost too because it has to ramp up and down. Just going back to the pricing, the inflexible price, the reason for the inflexible structure is because the old regulatory incentives attempted to design a power tariff in order to attract capital, and they used a fixed set of financial assumptions, not taking into account fuel fluctuations, not taking into account entry of new technology, and certainly not taking into account entry of cheaper technology. So now I'd like to move into the context of investment. So the context of energy investment is system dependent, which is typically country or location within a country dependent. So the context of regulation, the question of whether or not the country is an importer of fuels, the ability for the public to handle or address volatility, variability, and high prices, and how much land there is, all of this actually comes into the equation when we bring investment, because we're no longer talking about the cost of equipment or the cost of installing. We're talking about the economics of operating in a system. And in the Southeast Asian context, the growth trajectories are an important driver for power sector investment. It's also important to note that there's still 70 million people in Southeast Asia without access to energy. So the concept of moving power from a large power plant through a high voltage line one way towards the low voltage wires and then eventually to consumers has actually not delivered on electrification goals, and it has not delivered affordable prices. So in order to reach last mile electrification and to fulfill growth needs in a more targeted way, domestic modular renewable energy systems with storage can be more cost effective, and it's also a very good substitute for grid infrastructure while being able to supply power at point of demand. Modular renewable energy is also a way to de-risk the system because large 800 megawatt or more coal plants can be risky, especially if they have unplanned outages. And earlier this month, the Philippines' main grid was on a supply alert because we had over 2,000 megawatts of unplanned outages. So less reliance on imported fuel avoids the ups and downs of volatile commodity markets. So domestic renewable energy and storage can provide Southeast Asia with much needed price stability and resilience to external shocks. It can also provide employment and improve its competitiveness, which is important for potential growth. And it's also very important because the region is now attempting to set itself up to attract manufacturing companies that are looking to diversify their supply chain. So the technology disruption is fundamentally reshaping the global energy landscape. A key impetus is the dramatic ongoing deflation in the cost of solar energy and battery storage. Ongoing deflation of the cost of solar energy and battery storage. Specifically, we've seen their cost drop 80 to 90% over the last decade. And IEEFA expects that this will again have in the coming decade. So renewables are now a cheap source of energy generation, beating the cost of new imported coal. So such a global market transformation has implications for energy security, especially for importing coal countries like the Philippines and Vietnam. Domestic renewable energy allows for domestic diversification away from imports and helps reduce energy security risks. So while Southeast Asia in general is a renewables laggard, the developments in Vietnam, Taiwan, China, and India highlight the potential for change. For example, Vietnam appears to be shifting strategy towards offshore wind to be able to quickly supply growing power demand rather than wait for import coal plants, which take more than 3 to 5 years to finish. So offshore wind can be completed in half the time. We are also seeing a movement to auctions. Auction tenders have the capability to improve pricing through competition and transparency. So the key questions we want to ask, especially in the context of an energy transition, is what happens when the power sector modernizes? What happens when the industry, or when industries like manufacturing and consumers want to and decide to go for lower priced power options? And the other question is, what happens when grid operators decide that they want to prioritize power reliability and flexibility? Well, this is what's called an energy transition. And what tends to happen, and what we're seeing now in many markets, including Southeast Asia, is coal plant assets and contracts may turn from assets into liabilities. And this risk is known as stranded asset risk. I have a graph here that I hope can explain stranded asset risk in very simplified terms. I assume a contract to be 25 years, and the debt and equity investors are supposed to recover their investment during that time. Now, stranded asset risk for coal power continues to grow amidst low renewable energy and storage prices. So if we assume that by 2023, they are very uneconomical, they are already uneconomical today, but let's just assume that it happens in 2023. The yellow part here is what may be paid for by either end users by paying for stranded cost, or taxpayers through a bailout or more subsidies. Or it can also be paid for by investors through a write-off. So this means that no new coal plant should be built today because of this growing stranded asset risk, and all coal plants in the pipeline should thus be changed to be more cost-effective and domestically sourced. So now the question when it comes to the energy transition is whether it can be planned and orderly, or will we waste time and money by allowing new and flexible import coal plants to be built today, knowing their project economics is deteriorating. And this is my last slide. So the speed of the energy transition drastically changes with finance. In the last 5 years, government-owned export credit agencies of 3 countries, China, Japan, and South Korea, funded a major number of coal plants in Southeast Asia. Following the global trend of nearly 130 globally significant financial institutions beginning to exit coal finance, Asian financial institutions are indeed following suit. The 3 major banks in Singapore have put restrictions on fossil fuel financing. The Philippine Central Bank has put forward a framework that recognizes transition risk, including stranded asset risk. A major conglomerate in the Philippines will finalize its coal exit by 2025. Marubeni, Mitsubishi, and other banks in Japan are also beginning to put restrictions. The immediate impact is that it will be even more difficult to raise financing for coal projects because no one wants to be the last one holding the bag of stranded assets when the music stops. So no one's balance sheet will willingly take on a stranded asset. But as we know, bad economics is propped up by politics. So I think these moves on coal financing restrictions are a mix of stakeholder pressure to be Paris compliant, as the push for more disclosure and the economics of burning coal makes less and less sense. And I think more financial institutions and investors will put restrictions on fossil fuel lending because of the realization that the economics of coal were already under structural pressure before the pandemic and has now intensified during the pandemic. Just this month, a major conglomerate in the Philippines is attempting to raise a fourth tranche of a bond for coal-fired power plants, and it's about $120 million. And this is interesting because they're raising the bond through individual retail investors. They used to raise bonds through institutional investors. And so this may be that institutional investors' appetite for such projects have actually declined. And this is understandable considering the growing risk of coal plants. So now the opportunities, and I know I've run over time, but I'll be quick. European DFIs and IFIs in general can help buy down the cost and the time of this transition. The COVID-19 delays provide an opportunity to reset energy development policy and redirect resources to support energy price stability. So for example, European DFIs can support a program that includes fixing and addressing market design weaknesses and capitalizing on investment opportunities such as digitizing system management, enabling more renewable energy and energy efficiency. And finally, competition is key. So rather than price guarantees for renewables, such as the feed-in tariff, we need well-structured bidding, such as auctions, and auctions can deliver that low-cost power that countries need for growth and competitiveness.
Great, thank you, Sarah. So I think for now, I will ask a few questions following up on that presentation and give everybody a chance to put some questions into the Q&A box, and we will get to those questions pretty shortly. Just talking a little bit about, the presentation and the growth that's happening in Southeast Asia. I wonder if you could say a little bit more about some good examples that you've seen in the region in terms of investments. So, you mentioned Vietnam. I think offshore wind definitely seems to be growing pretty quickly, but also solar as well. Is there anything more you can tell us about, why Vietnam is sort of jumping out ahead in the region in terms of renewables investments?
Yep. So it's very clear that the Vietnamese government is trying to fulfill their growing demand, and they realize that the quickest way to do this and the best way to work to engage with renewables is at scale. And so they have clear policy direction towards offshore wind, and they've done the same with solar. And I expect that Vietnam will probably outpace the rest of Southeast Asia in terms of renewable energy investment. But that's not to say there's nothing going on in Indonesia or the Philippines. In the Philippines, they did have a feed-in tariff round, and that worked quite well. There were 1,000 or more megawatts installed of renewables, but what we're seeing right now is there is modular renewable energy being set up in the Philippines, where they're taking advantage of if there's incremental demand and you don't have an offshoot of thousands and thousands of megawatts at a time, it's a good way to actually fill that demand. In the region generally, we're seeing an uptick of floating solar, which is when you put solar panels on hydro plants or hydro dams. And so the region is certainly moving towards that direction, although quite slow. But I think with the right financing, with the right low-cost capital that's sitting in Europe, it can certainly accelerate the transition.
Great, thanks. And thinking about the fact that we're talking with an audience that is primarily based in Europe. I think also some folks joining from Asia and other places. Can you talk a little bit about the extent to which these types of investments, these large infrastructure energy investments, really depend on outside investors not in Southeast Asia, so from Europe or from other parts of Asia, the US? What role does the international financial system play in getting these projects going, for better or for worse?
Yeah. Well, international investors have the track record of investing in renewable energy projects in their home countries or in other parts of the world. So they do have that project expertise and that understanding of the yield strategy that renewables brings to the table. The other side of it is having international financing also means typically it's lower cost financing because, and I'm talking about the debt side specifically, just because we're seeing very low interest rates in Japan, in Europe, and even in the US. And so if that can come to Southeast Asia, obviously with an added risk premium, that would be quite helpful, because having access to that capital is also a means to accelerate the transition. Because right now, if we look at who's supporting this coal-fired power plant build out, a lot of it are export credit agencies from Japan, Korea, and China.
And in terms of, I guess, thinking about the coal side, not just the clean energy investments, do you think that the move away from coal by European banks has helped to drive some of the changes in Southeast Asia? Do you think that more banks will follow suit besides just in Singapore, or do you think it'll still be pretty difficult to stop some of the local banks from financing, even as institutional investors and sort of Western banks move away from it?
Yep. So I think smaller banks are in a difficult position where they do need to follow their client. And so, if their client is building out a coal-fired power plant, it's typical and it's usual for them to do that. But what we're seeing now, even in the smaller banks, and I say smaller, but they're actually quite large in value, they're running, like they're taking into account ESG. The Central Bank of the Philippines has put in a sustainable finance framework, which means they're going to start valuing these risks and opportunities. And in the case of the Philippines, there's a clear realization that actually it's the banks that are likely going to hold on to these stranded assets. And they obviously don't want to do that in the future. And so what we will likely see is, instead of project finance for these projects, a shift away to bonds, and bonds not for institutional investors, but for retail, because institutional investors are well aware of the risks. So coal finance will be hard to find, not only because of what's happening in Europe, but just because the economics are very bad in country.
Right. So I think from there, I'll jump into some of the questions that we've already received on the Q&A. And I think one question that seems very related is about the bad economics. So you mentioned that bad economics are propped up by politics. And so what would be examples of good politics?
Good question. Good politics would be good policy, which is an auctions framework. And we see this, and we see India actually take advantage of this policy directive, because auctions allows that competitiveness, that price transparency, that allows renewables to better compete. We also saw the largest battery solar auction in India, I think earlier this year. So it's certainly possible to have large scale power using auctions. And as far as bad politics is concerned, it's a matter of whether or not the country continues and willingly continues to subsidize something when there are cheaper options out there. It doesn't make economic sense considering COVID-19 implications on public balance sheets. I think though the countries that are considering that have subsidized in the past may want to or may look at renegotiating some of these contracts, because it's quite a sizable investment.
And what do you think about the sort of clean coal narrative propagated by some countries, that the emissions are nominal and will investments increase in Southeast Asia in quote unquote clean coal?
Clean coal, I don't think that exists. I mean, I don't see that emission standards are in place to warrant such a statement or such an investment. Yeah, so I think that the bottom line is there is no clean coal. There's fossil fuel, and there's renewables, and there's domestically sourced, and there's imported. So I think the focus should be really on competitive sources, which happens to be renewable energy.
And I guess for folks who may not know as much about coal and why there is a label for clean coal, it's more of just a particular type of coal plant that runs at a certain temperature and efficiency level, but that doesn't actually generate significant decreases in emissions, just for folks who might not know the term that well. And then sort of a related question that came in is, how widespread is the notion of carbon pricing, a fee or a tax? How has that, gotten traction or hasn't gotten traction in countries in the region?
So I think there has been discussion of pricing this externality, because it has led to huge health costs for the public sector as well as private sector in terms of people. So I think as governments look for new sources of revenue, this would be an opportunity to do that. However, there are implications, because a lot of these contracts, these coal contracts, are automatically, any increases is automatically passed on to consumers. So at the end of the day, a carbon tax may end up with high cost to consumers, but there are ways to obviously redistribute that. But I think that's something that needs to be taken into account in the Southeast Asian context. However, with definite need for new sources of capital or new sources of tax, pricing externalities is a good and one of the most economic things you can do, especially if we're looking to reset or redesign the system. We want to make sure that positive externalities are given incentives and negative externalities are priced.
Thanks. And talking about the job opportunities. So if we're talking a lot about job transition in the region and having to train people who traditionally might work in fossil fuel power jobs and towards renewables, how much of the investment and time and government policy has gone into looking at the jobs question and retraining people for a sort of a different part of the sector?
So in the Philippines, there is it's a government entity that focuses on training and training for new skills or trying to upgrade skills. And so they do have training already for solar installers. So it's a way to get certification, and that way it's easier as well for solar companies to hire. And I think when we're talking about, just because the COVID-19 crisis is front and center, if we're looking at protecting employment and jobs, there's that, and then there's also social welfare involved. So a good way to actually direct social welfare, instead of a direct handout for not the, I guess, income levels above low income, like a little higher than the working poor, that target segment would actually be quite good to invest in renewable energy or in green jobs, this just transition investment. That would be a good way to stimulate the economy and to make sure that we can retain as many jobs as possible and prime them to be ready for when we're already past the recovery stage and back to the growth stage. prime them to actually have jobs that'll be more long lasting, instead of what we're doing right now, which is trying to let this dying industry survive, or trying to prolong it, when at the end of the day, the end is the same. It's just a matter of timeline. And I think the quicker we can end this old technology, the better it is in terms of long-term growth prospects for countries.
I think there was a graph you showed earlier looking at, the cost of different technologies, but also the technologies and how they complement each other in a more variable system. And one of the questions that came in was about capacity factors, right? So you have renewables like solar and wind, the capacity factor is lower than firm resources like coal and natural gas. So what is the role of gas in the energy mix and in the transition to 100% renewables?
So the capacity factor argument isn't very, I don't think is very conducive, because what we need to look at is how much is it per kilowatt hour at that time of day. It doesn't matter whether it's gas, coal, renewables, battery, whatever it is, as long as it's the cheapest at the per kilowatt hour price, rather than it has a capacity factor of 80%. Because today coal capacity factors are down to between 50 and 65%. They're supposed to be at 85, but they're much lower because we're not using it. So I think if you want to compare across, instead of comparing utilization rates or capacity factors, you should compare the per kilowatt hour cost or price of each technology. And then if we're thinking about LNG, so gas has been pitched as the transition fuel. And unfortunately, unfortunately for gas, storage prices have come down drastically. And the cost competitiveness of gas is actually at risk. So the same story, whatever happened to coal might actually happen to gas, but it might happen to gas sooner than we expected because of this downward trajectory of storage prices. The other thing to note is in countries, and the conversation in general is always, oh, the gas price is very low, the LNG price is low, we should be building this out. Well, not factored into the low price is all this additional infrastructure that you need to build out in order to convert the gas, in order to pipe the gas. So this and added infrastructure is missing in the conversation. And so it's actually quite inaccurate to say that gas is cheap just because you're forgetting the gas price plus infrastructure.
Right, and I think that's also true when thinking about gas relative to coal. I think the emissions at the actual power plant are lower, except that the infrastructure that you mentioned also generates significant power needs that also create more emissions. So I guess a sort of a related question to that that came in is, what do you think about carbon capture, utilization, and storage as a sustainable solution? The IPCC has highlighted it as a key component for 1.5, but it seems to also encourage sticking to fossil fuels. So what do you think about the prospects of CCUS in the region?
I think we need to, for the Southeast Asian context and developing countries in general, we need to think about the price and the cost per kilowatt hour. And we need to talk about the real price and cost per kilowatt hour. So if we add CCS technology to already expensive coal-fired power plants, I just don't see the math adding up. I don't see it being cheaper than domestic renewables and storage. So while it might be the case maybe in developed countries, I don't know if it is, but in emerging markets, Southeast Asia, yeah, I mean, that just looks like added cost rather than improving anything. The bottom line is Southeast Asia is a growing economy. They have a pretty good, well, they had a good growth trajectory prior COVID-19, and it's expected after this passes that they should be on track to be a large or a strong engine of growth. And so this means that they need low cost power. And CCS plus coal is not low cost power, so it just doesn't make economic sense.
Yeah, you mentioned in the current COVID-19 situation, and to what extent does that influence your projection of the rise of energy demand in Southeast Asia? Is it easy to predict what the changes are going to be in trajectory, or is that still in flux in most of these markets?
Yeah. Yeah, I think it's honestly still in flux because it depends on whether we will have a start-stop, or if it'll be a slow start. It all depends per country, but I think generally we can assume that the capacity additions that we thought were needed in the next 2 years will have some delay. And so this is good in that we can actually reset these projects and shift them towards either renewables or storage, considering the project economics of coal is deteriorating and that renewable energy, despite COVID-19, the prices have gone down. And so I think it's now time to redesign the market to ensure that it allows this least cost system to actually be constructed rather than coal plants.
Well, I mean, I think the thing you mentioned earlier about, export credit agencies financing a lot of this, part of the argument for why they finance it, obviously, besides the fact that it's designed for, their exporters to make money off of the deals, is that these coal plants are cost competitive in the region. And so, one of the questions is about, how much is the risk of stranded assets over the lifetime of those projects? And then who will carry the risk under the way the contracts are structured, the PPAs, et cetera. And I mean, I think my question building off of that is, do the investors expect to get bailed out? Is that sort of the expectation if the project economics are not there? Or do you think the investors are not looking closely enough at the revenue projections and just assuming that everything is business as usual and power markets have not changed?
Yeah. So whether or not an investor thinks it will be bailed out depends on the market structure, where is the utility company state-owned or privately owned. In the case of Vietnam and Indonesia, they are state-owned. And so the contracts are written, so really it's the public sector that holds on to the stranded risk, because the power purchase agreement allows these investors to be guaranteed a rate of return regardless of performance. So stranded risk, stranded cost will end up in the hands of the public balance sheet of the recipient country. And in the case of the Philippines, because it's privately held, it used to be prior to 2019 that if you're a coal plant operator, you're effectively guaranteed your minimum return, minimum being 14 to 15% internal rate of return. But now in 2019, the biggest utility company in the Philippines has decided to include a curtailment clause or carve-out clause, which means if there are cheaper options that come and thus you buy less from the coal power provider, you don't have to pay for not using their power. Instead, you just buy less from them. And so this means since you're buying less, the stranded asset risk now sits with the investor. And this is a realization that the local banks are now figuring out very slowly, that, well, they're the investor because 80% of that debt is theirs, and they have typically a 15-year term on these loans. So if they're unable to recover that in 15 years, then they're sitting on some stranded project debt. So yeah, it certainly does depend on the market.
Yeah, and speaking of one market in particular that a few folks have asked questions about, for Indonesia, which is a large coal exporter and the most populous country in the region, can you talk a little bit about what's happening with the coal situation there in terms of not just exports, but also the plants in the country and the stranded asset risk?
Yep. So there was actually a report by IEEFA, by some of my colleagues who cover Indonesia, specifically about the Indonesian coal mining industry. And so the reason coal mining is attractive there is because for the government, besides employment, is that they typically have royalties that are paid to government. However, given COVID-19, given the low price of coal, a lot of them are operating below below break even or very close to break even, which means they can't actually repatriate any royalties to the government, or very little, less than what the government expected. And so this really calls into question what their value is. So that's one side of it. The other side of it is that the coal price itself, if we look at the power purchase agreements in these importing countries from Indonesia, so the Philippines imports about 80 to 90% of their coal from Indonesia, the price on the power purchase agreement is far less than the break-even price of a coal mine in Indonesia, which means it's artificially low on the contract, but they know that it doesn't matter because it's all passed through to the consumer anyway. So it can be 10 instead of 1, and it doesn't matter, it's passed through. And that's the same case in Indonesia as well, where the everything is passed through to the government, because the government subsidizes power for the consumer. So they're subsidizing in the end, they will subsidize both their mining and their coal plants and the entire power sector, if they don't change or shift trajectory. And I think that's an ongoing debate in Indonesia right now on whether, I guess, it doesn't make sense to not receive those royalties. Does it make sense to continue to subsidize the sector that's clearly just not going to get any better? It'll likely only get worse.
Well, thanks so much for all of those insights, and we are going to have to close the Q&A as we're about at time now. So I want to thank everyone who has joined, and for those who are members of Asia Society who registered for the follow-up discussion. We will hop over to that line to answer some of these other questions that came in. I think there are quite a few more about specific countries and the situation there. So once again, thanks to Sara and to Asia Society Switzerland for hosting this conversation, and hope that we will see good developments in the region.